Every asset class appreciates in value or depreciates in value for different reasons. That is why it is better to understand what are all the different asset classes and how they work. We have investment expert Sadish Prabhu with us. Sadish Prabhu, could you please help us understand asset classes better? Over to you, Sadish.
What is so unique about these asset classes? And first and foremost, let us look at our favorite asset class, which is equity. And let me be honest here that all of you will be familiar with these qualities, but I am just trying to reiterate some of the facts that you may be already aware of. Now, equity has the potential to provide us superior returns. We all agree that equity as an asset class has the potential to provide us higher returns. It has the ability to beat inflation. If today inflation is 6 or 7%, equity has the potential to beat inflation. It provides us good liquidity because if you need the money, you are in a mutual fund, you can get the money on a T+2 basis. But it also has a flip side. It carries a higher amount of risk, which I just said that if the markets fall by 40 or 50%, your portfolio also falls by that amount. So it fluctuates a lot. That is the biggest risk that equities carry. And that's the reason we find that a very small proportion of people invest in equities. Market slumps, and you also need experts to tell you where to invest in equities. So it is also important to know which funds to choose while investing in equities. Another simple asset class, bonds or debt, less volatile, obviously. It gives you fixed returns. The bonds have a fixed coupon and the returns fluctuate less. Obviously, it gives you better returns than cash, okay? But you have to look at, when you look at investing in bonds, you also need to look at who is issuing those bonds. Is the issuer a AAA rated issuer? So rating of the bond is very important because a lower rated issuer may give you higher returns, but also carries a higher risk. So are you ready to take that risk is a question. And here too, people who in bonds generally prefer a AAA rated bond with a lesser risk, but a lesser risk also comes with lesser returns. There is also what we know as interest rate risk. Now, what do you mean by interest rate risk? Is that interest rates can rise or fall. Today, in the current scenario, you will find that you will be happy to invest in bonds because they are offering you higher interest rates. But there are scenarios in which interest rates fall as well. So the rise and fall in interest rates creates what is known as an interest rate risk, because of which you have price fluctuations or NAV fluctuations in mutual funds. And very technically, if I have to tell you that NAVs fall when interest rates rise and NAVs rise when interest rates fall. There is an inverse relation, but that is very technical. You just have to remember that bonds also carry a little bit of risk when interest rates rise or fall. And obviously, there is a risk of inflation. So interest rates and inflation go hand in hand. When inflation rises, interest rates also rise. And you find in the US, the whole reason why the US Fed is increasing interest rates is to match inflation. It's the first time in 40 years that they are seeing such high inflation. So it also carries the risk of inflation. We move on to cash. Again, cash is a very simple thing. It has the lowest downside risk. So there is no interest rate risk. There is no downside risk. There is very high amount of liquidity. But what cash offers on the downside is lower inflation risk. So it carries the risk of inflation. If you keep a 100 rupee note with you for 10 years, you will not get the same value for that 100 rupees. So that is the reason all of us invest either in equity or debt or gold. just to increase the value of that currency. Moving on to real estate, again, it has superior return potential. It can also provide regular income, rental income. But the biggest challenge, I would say, is illiquid. It's very illiquid. If you need a lakh of rupees, you cannot sell real estate. You have to sell some liquid assets. So that is the flip side. And again, real estate also needs experts. It also needs a very large capital outlay. And I stay in Mumbai, and in Mumbai, you cannot get a flat for anything less than 1 crore. So you need a lot of money to buy real estate. So that is another, negative about real estate, that it needs a larger capital to purchase real estate. And obviously there is high maintenance, and you have to constantly monitor your property for wear and tear. So there's a lot of work to be done when you invest in real estate compared to financial assets, which are lying where they are, and maybe you just need to check their performance, etc. Last but not the least, one more of our favorite investments, which is gold. So while it is a store of value, it is a good hedge against inflation. You can hold it both in physical and digital forms. However, it is not up to the mark when it comes to giving returns. So while it has given good returns in patches, but I will show you a graph where equities have comfortably outperformed gold. So if you want higher returns, then your allocation to equities need to be higher. Gold, I would say, is a good diversifier. What do I mean by diversifier? I showed you a table where equity and gold are, one is at the top and the other is at the bottom. So typically it helps you balance your returns. So when equity does well, gold may not do as well. And when gold does well, equity may not do as well. So if you have a balance of allocation between equity and debt, you may have a good risk-adjusted returns. So I'm not saying no to gold, but you may not have as high a quantum of gold as you have of equity, because equities have obviously a higher return potential. So keep that in mind when you invest a lot of money in gold.
Thanks for your detailed answer. If you have any questions related to this or any other investment options or related to your financial goals, feel free to book a free appointment with our financial planner. The link to the free booking is given in the description below this video. Also, will you be interested to attend insightful investment webinars? Then feel free to register for our upcoming insightful enlightening investment webinar, and it is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give a thumbs up. Also share it in your social circle. If you are not subscribed to our YouTube channel so far, please subscribe now. Bye.